Hello, everyone, and welcome to the Options Income Blueprint, how to turn losing trades into winners with Jeff Tompkins. This is your host, Richard Van Rich, and we're excited to have you guys with us here tonight. We got a lot of great information to go over. You may notice that your microphone's muted. That's so we can hear Jeff and I talk. But if you move your cursor around, there's a Q&A box. You can pop questions in there. We'll answer those throughout the session and also before we sign off at the end. If you do have to hop off, this is recorded, but we do encourage you to stay on so you can make sure you can hear all the questions and all the information that Jeff's going to have towards the end of the session. Before I bring on Jeff, let me just read the disclaimer. Trading securities and options involves risk. Prior to buying and selling an option, investor must receive a copy of characteristics and risks of standardized options. Investors need a broker to trade securities, and options must meet suitability requirements. Past results are not necessarily indicative of future performance, and performance figures are based on actual trades, including real money results. Due to time-critical nature of trading, broker fees, and the activity of other subscribers, there's no guarantee that subscribers will mirror our performance. Performance numbers shown are based on trades users could enter based on the trade signals. All right, with that being said, let me bring on Jeff. Jeff Tompkins, you there?
Hey, I'm here.
All right.
We're we're back at it.
Back at
Yeah,
it.
good to be here. Hey Ted, yeah, hopefully that echo's gone. Occasionally that will happen when we're sharing audio on our end with the pre-webinar music, but hopefully that's resolved for you now. Let us know if not. All right, welcome everybody. Let's do just a quick audio visual check. If you guys could just give me a oh good, glad to hear Ted. If you could give me a yes or a Y in the chat, let me know you can hear me okay, loud and clear. See my screen? All right, awesome. Thanks, Jack. Thanks, Yuri. All right, thanks, Tony. Thanks, Belinda. Thanks, Edward. All right, looks like we're good. All right, so we're going to start off with a little quiz. Well, first of all, we're here to talk about our options trading blueprint and how we make adjustments to some of the more popular option strategies when things don't go as planned. But we're going to start off with a little quiz here. So you can throw this in the chat. Moving forward, if you wouldn't mind using the Q&A for actual questions related to anything we cover on the session, that would be great. It helps us manage that easier. But for this, you can use the chat. So anybody have any idea what these two products have in common? Common household products, WD-40 and the Nintendo gaming system. And I realize this probably doesn't seem trading related, but I'll show you how this is relevant here momentarily. So anybody have any idea what WD-40 and Nintendo have in common? It's a tricky one, I'll give you that. It's not obvious. Tony said no longer exist. Survival. Okay, we got one coming in that said survival, and that's pretty darn close. So I'm gonna go with that one. That's the winner there. We're gonna Okay, Palin got it as well, failed too many times. So a lot of really good answers. Jorge said adapting. Yeah, so those are all essentially the right answer. So what I was really looking for is that both Nintendo and WD-40 failed miserably earlier in their product life cycles, which is somewhat hard to believe because they, went on to become so successful. But we now know Nintendo is the company that launched the whole home gaming era, but it didn't actually start out as a success. So their first offering, which was the Famicom console, had to be recalled after only a few months. And then Atari came along in the mid '80s and kind of messed the whole market up and created a lot of confusion. Nintendo addressed that by coming out with a new system, the NES, but then they barely sold any of that when it was introduced in '85. So they encountered a lot of failures, right? And ultimately, they introduced those two little guys you see there, Mario and Luigi, in 1986, and that changed the entire history of the American gaming industry forever, right? It really the focus went away from the system to the game, right? So that's really where the interest, right, lied with consumers. Okay, they weren't so concerned with the mechanical part of it, the system. They were interested in the game, and so that focus shifted, and they changed their entire business model and went from a failure to a really huge success, right? We'll see kind of similar thing with WD-40. So if you ever wonder where WD-40 got its name, It comes from the fact that it represents the 40th attempt to create a degreaser and rust protection solvent. So they had a lot of uh, problems getting it into an aerosol product. It used to be used in the aerospace industry, and then employees started utilizing it at home and suggested, to the company that it be packaged in a way that it could be used for home use. But they ran into all these issues, right, with the formulation. So you can imagine if they'd given up after 39 tries, we may not have WD-40 as we know it today, or at least we wouldn't have the company who's the market leader in this product space. So these are two major companies that have gone on to become major market leaders and huge successes that failed many times early on in their product lifestyle cycles. So this is where it ties into trading, right? So we face failures in our trading and investing as well. And so we can give up and try something else. We can keep going and repeat failures and blow up accounts, right? Those are obviously things we want to avoid. We want to stick with it and be successful in the long run. But there are a lot of reasons for failure. So when it comes to trading, there are all kinds of things that can lead to our failure. But I like to look at trading as a business. And ultimately, like any business, there's revenue and there's overhead. And it's really the losing trades that are our overhead that can wipe out the profits from our winning trades. Because frankly, as long as you can stick with it long enough, you're going to have winning trades and you're going to have losing trades. But we want to, like any other business model, minimize our overhead as much as possible, and make money over the long run. So have a positive expectancy. So there will always be losing trades that are the biggest overhead that we face in the trading business. It's a relatively low barrier to entry business, right? You just need an internet connection, a computer, and a brokerage account with some risk capital, right? And you're in business. So we want to minimize that as much as possible. And where we can really do that is with trade management and trade adjustments, because inevitably there's going to be periods where things don't go as planned, and that's where we tend to have a losing trade. And so if we can mitigate that, or even take a losing trade and turn it into a net profitable outcome, that can make a dramatic difference in our overall results. So the good news is, and I found that this is from personal experience, 75% of the losses I was experiencing prior to focusing on trade management and trade adjustments can be fixed or even avoided completely. So up to 75%, that's a lot, right? I'm still going to have losing trades, but I can drastically mitigate my losers, and in many cases take those trades and transform them into net profitable outcomes. So there are always going to be losses as a cost of doing business in the trading world, but a lot of them can be avoided and turned into profitable trades by making just a few simple tweaks. So like we'll look at some of the more popular, commonly traded option strategies on the session today. So like an iron condor. Let's say you've set up an iron condor on the S&P 500 index, the SPX, and things aren't going as planned. And by the way, if you're not familiar with these strategies, I'll break all these down for you. But let's say we set one up on the SPX, the market throws us a curveball, and we're facing a loss of $3,900 in the trade. So we could cut our losses there, or maybe that's even a max loss, and we just have to accept it and move on, right? Or we could potentially make a tweak to this trade and turn it into a net profitable position of $2,400. Or another popular option strategy, the credit spread. This is often one of the first strategies people transition to after just buying single leg calls and puts. And let's say we'd set up a credit spread on the QQQ. And again, things don't go as planned and the trade's losing $580. So we could accept that loss or make a simple adjustment to this trade and turn it into a $620 potential profit. Okay. Another option selling strategy, a naked put. So let's say we sold put premium on Ciena, CIEN, and the stock sells off, which is what we don't want it to do, right? Things aren't going as planned. Trade's down $730. We can cut our losses there, move on to the next trade, or make a simple tweak to this losing position and turn it into a net profitable outcome of $540. Okay, well, these are not hypothetical scenarios. These are actual real world scenarios that we encountered with our Altos members over the years, where the market threw us a curveball, something didn't go as planned. Not that we did anything wrong. We followed all the rules, did the trade right, but the market changed on us, right? And that's everyone's vulnerable to that. And rather than just taking the loss, we adjusted these positions into net profitable outcomes. So I'm going to show you on the session today exactly how we accomplished this. I'll give you the exact adjustments and we'll walk through these strategies. So these are all actual real world examples. They're not simulated, they're not hypothetical. All right. So I'm also going to be sharing some of my own real world, real money results out of my personal trading account. And this is from back in 2015, specifically August 24th, 2015. So over a decade ago, where, and I still do so. I still sell put premium for income in my personal trading account. I was doing a lot of that back in 2015. And at this point in time, my entire portfolio, every position in my account was a short put. So I sold put premium on, a dozen or so stocks and ETFs. So these are all short puts. Does anyone know what the significance of August 24th, 2015 is, just out of curiosity? And oh yeah, see the question. Yeah, we can get you a copy of the slides. We're also recording the session, so you'll get a copy of the recording as well. Anyone know what August 24th, 2015 was? Yeah, so it was the flash crash. So Dow opened down, I think, around 1,000 points or something. It was an unprecedented percentage down move at the cash open at that point in time. So pretty much everything was down, right? You were hard pressed to find anything that was going up. And if you're familiar with selling put premium, that's what you don't want to have happen, right? You don't want to have a major sell off when you're short puts. Well, if you look at the percent change column here, right, every single stock index or ETF in my portfolio was down significantly, some double digits. Okay, but then if you look over to my P&L, it's showing positive $7,600 and change. So how is it that I have a portfolio of short put positions that are all down? The underlying stock, ETF, or index are all down, but I have a positive P&L of over $7,600. So this was accomplished with a very specific adjustment technique that I'll share with you on the session. So we're going to come back to this and I'll show you how I did this. All right, but I want you to know there is an adjustment to fix virtually every bad options trade. Okay, we can't fix all of them, but in many cases we can mitigate losses or transform that bad trade into a net profitable outcome. So over the next hour, I'm going to reveal a few of my most effective adjustment techniques to fix losing options trades. So again, you can do this with virtually any strategy. You could take a losing credit spread and, for instance, execute a delta neutral hedge and transform it into a potential winner. You could take a naked put and you can execute a horizontal roll and take that losing naked put and transform it into a potential net profitable outcome. You can do it with single leg calls and puts, right? So let's just say you bought a call and the call's losing money, right? You could, for instance, transform it into a vertical spread. And when done in the right way, you can drastically mitigate a loss or even turn it into a net profitable outcome. So we're going to look at some of these popular option strategies on the session and show you how we accomplish this. Most of you are familiar with me, but again, just give you a quick background. So I've been trading for over 2 decades, pretty much traded every market, every asset class, equities, ETFs, options, futures. Most of my trading now is in options and equities and ETFs and futures. But I did my professional training as an intern at the trade desk at Morgan Stanley back in the early 2000s. That was my first glimpse into the institutional side of trading. And prior to that, I'd only been trading on the retail side for myself and my own account for, I don't know, 4 or 5 years. So, I was fairly green at that point in time, relatively new to trading and still trying to figure a lot of things out. But I quickly noticed the big gap between retail and institutional trading and how many, just the different approaches that were used. But, tools and strategies institutional side had over the retail side in terms of an edge. And the big thing I noticed was the focus on trade management. So when I first started trading, I was so focused on the trade entry. I mean, I was probably entirely focused on it. Not enough attention to the management and exit of the trade. Okay, so that's one of my goals is to help people with that, focus more on that part of it because I'm a strong believer, and I've actually done a little bit of my own, N of one study on this. That you could throw darts at a dartboard on trade entry and still make money if you manage the trade correctly and know how to make adjustments to it. So once you do, that's a big weight off the shoulders, right? But we started Altos a little over 10 years ago with that a goal in mind of helping retail traders reach a more of a institutional level. Even if you're not trading on the institutional side, most people aren't, and that's fine. But at least having the mindset and tools and strategies and all that are utilized on the institutional side, which I now trade on as well. So I still trade my own account, but I also trade on the institutional side with Altos Capital, where I'm the hedge fund manager. And over the years, we've launched a lot of options alert services that we issue weekly alerts on to our members. And so we've done thousands and thousands of these trades over the years. And so we have a real world track record, right, to back up what I'll demonstrate on the session today. We've traded through virtually every market environment you can imagine, right? From bear markets to bull markets to black swan events, both secular and cyclical markets, all the above. And we've come out ahead. So I think that says something. So by the end of our session, you're going to discover my top option strategies for volatile markets, how to make adjustments when the market becomes more volatile and erratic, and even turn losing trades into winning trades. So I'm going to reveal some of my top trade adjustment tricks to reduce risk and increase profit potential. So whether you're just starting out or you've been trading for many, many years, this is, I think, critical information to have for today's markets. So one of the first questions that comes to mind when we start trading options is, should we be an option seller or an option buyer? Because we have that flexibility, right? We could sell options, we could be a net seller, collect premium for doing that, or we could buy them. And I do both. So when I get asked, which is better, it's largely personal preference. It's also based on market environment, implied volatility levels, all kinds of things that need to be taken into consideration when you make that decision. But if we look at the objective side of it, so there might be personal reasons or whatnot, but if you just look at the statistical side of it from the options perspective, right? Selling options tends to have better statistical odds than buying options. And I've also looked at statistical comparisons with casino games because we know that casinos have an edge over their gamblers, right? They have a built-in edge in the games that they offer. And that varies pretty widely. Whereas you follow very specific rules in blackjack or you only place very specific bets in craps, right? You have a much better edge, but the casino still has an edge over you. It could be around 1%, right? But even a 1% edge or even a 0.5% edge can equal millions of dollars over the long run. So it doesn't take a whole lot of edge to make a big difference in your P&L over the long run. But when we're looking at bullish option selling strategies, neutral to bullish, we have three ways to win. So the underlying stock can go up, it could stay flat, or it could move down slightly. So I think this is important because it creates an immediate edge off the bat. If you compare this to buying a stock, for instance, right? If you buy ABC stock, you only have one way to make money. The stock has to go up. If it stays flat, you don't make anything, you don't lose anything. If it goes down, you lose money, right? Whereas if you sell an option in the right way, you could potentially make money in all three of those circumstances. So it has that advantage. It also allows time decay to work in our favor. So these are all built-in statistical edges that we don't really necessarily have to do much to accomplish. All right. There's also typically more room for error, and it's typically easier to adjust these types of trades. So as I mentioned earlier, you can adjust any options trade. There's a multitude of ways to do that, but I've found that when you sell option premium, uh, it's more conducive to the adjustments that we're going to look at. All right, so let's start diving into some strategy. And we'll start with one of our core strategies that we use at Altos, which is selling puts for income. So this is often referred to as a naked put or a short put, and it's when you sell to open put options. And for doing that, you collect a premium or credit in your brokerage account for entering that trade. All right, so when the stock rises, the put options that you sold expire out of the money, you get to keep the entire premium that you collected when you sold them. So just a generic example. Let's say you are looking at selling puts on ABC stock. The stock's trading at $100 a share, so you decide to sell to open 10 contracts at the 95 strike for $250 a contract. And let's say those expire in 14 days. Each contract controls 100 shares. You receive an immediate deposit of $2,500 in your brokerage account. So that's your max profit potential. And as long as that stock closes above $95, that's your strike price at expiration, you keep that entire $2,500 premium that you receive when you put the trade on. Okay, so that sounds nice, right? And it's fantastic when it works out that way. And the way that we sell put premium, that happens about 90% of the time. Okay. But that leaves that 10% of the time when things don't go as planned and we have to use plan B. So I'm going to get to that. But first, I want to put aside some common misconceptions with this. So there's this misconception that selling naked puts is extremely risky, and brokers kind of treat it that way. They require a higher level of options approval, right, to trade naked puts. Interestingly, if you overlay a naked put risk graph on top of a covered call risk graph, they look the same. They're the same risk profile. So the obvious difference is, right, in one case you own shares of the underlying, the other you don't. And so where this misconception comes in is that you have the potential to abuse it, right, to over leverage. So that's the reason that brokers treat it that way, even though it has the same risk profile as covered call. So as long as you use good risk management, good position sizing, right, then you should be okay. One of the biggest mistakes I see retail traders make is just oversizing, trading way too large for risk tolerance, account size, experience level, all those things. But when you do this correctly, it can be an incredibly consistent method for collecting income from the options market. It's actually how Warren Buffett often acquired stock for Berkshire Hathaway. So, he would sell put premium to acquire shares at a lower cost basis and get paid to do that, right? He's collecting credit or an income for selling the put contracts because he wants to own shares of that stock. That's not our purpose. So we're not selling put premium with the intention of being assigned shares of the underlying stock. We're purely doing this to collect the premium and profit off of that. Okay. So when most people unfortunately put on trades, right, they do it with a hope and a prayer. So they're just kind of crossing their fingers and hope everything goes well. And if things don't go well, probably 90% plus of traders don't have a good backup plan. Okay. This is where you need to set yourself apart and always have a backup plan for any trade that you enter. This really is, I think, one of the biggest differences between retail and institutional or amateur and professional traders is the ability to effectively manage trades that aren't working out. So rather than, enter a trade, cross our fingers, only have one exit strategy, we either win or take a loss, right? We can actually adjust these. So when a trade doesn't work out as intended, it doesn't have to be an inevitable loss. A simple tweak can often save that trade and even result in greater profits. This is where it gets a little counterintuitive. So I'm going to elaborate on this momentarily. But what do we do when things go wrong? So with every trade that I enter or that we do with our Altos members, we have a primary exit strategy. In the case of selling put premium, this is where the put expires out of the money, right? And we keep 100% of the premium collected. And just based on the deltas we're selling, that should happen about 85% of the time. We incorporate technical analysis, implied volatility analysis, and a number of other things that allow us to actually increase that percentage of success to reach our primary exit strategy. So it's probably closer to like 90%, or we don't even have to touch the trade. But again, that leaves about 10% of the time where we have to make an adjustment. And one of our most powerful adjustments for this strategy actually can result in greater profits than had nothing gone wrong to begin with. So this is where it becomes a little counterintuitive because our brains are wired to think if something goes wrong, right, maybe we can make it a little better or maybe it'll get much worse. We tend to think when things are bad, they're going to get worse, right? But we wouldn't tend to think that if something goes badly, that we can actually come out better off. Well, this can be the case with some adjustment strategies that I'll share with you. So let's dive into that. How do we adjust to losing short puts? So let's say we sold put premium on a stock and things aren't going as planned. The stock starts to sell off. Okay, well, there are two primary adjustment strategies that I use in this scenario. We'll cover both of them. So the first is rolling. Now, rolling simply involves closing out our initial trade, the short puts, and then opening a new trade at a further out expiration. And I'll typically do this at the same strike and the same number of contracts. So this is important. I'm not necessarily increasing my position risk exposure, right? I'm not scaling up my contract number of contracts. So all I'm doing is extending the time horizon. Occasionally I'll do a vertical roll as well by rolling the strike up, but we're going to keep it simple and just say same strike, same number of contracts. But the key is we want to do this for an equal or greater credit into our account. And I'll get to that and we'll look at some actual examples. This one adjustment strategy alone has resulted in out of 431 closed positions in our put selling service. So we've been doing this for over a decade with our Altos members. Okay, 431 closed positions, 430 net winners, and one net loss. So that kind of track record is unheard of, right? That strike rate, that success rate is unheard of. But we were able to accomplish this just using this one adjustment strategy. And again, I'll show you some real world examples so you know how to do this. But let's get to the next one. That's delta neutral hedging. So this one's a little more complex, but to transform a naked put into a delta neutral position, we buy to open enough at the money or near the money put options to offset. We often can't get perfectly delta neutral, but that's okay. The positive delta of our existing short put options. So when you execute this adjustment, if the stock continues to fall, you can profit on the put options that you purchased, and that profit can offset the losses on the ones that you sold if the stock continues to move lower. So we'll typically use this adjustment strategy if the underlying is selling off significantly, right? Or your puts are moving in the money aggressively. And again, we'll look at some examples. So let's do that. We'll start with rolling. Okay, and this is a real world example we did with our Altos members back in July on Delta Airlines. So on July 18th, we alerted our members to sell the 52 strike puts on Delta with an August week first expiration. So we're just going a couple weeks out in expiration. And that could be done at the time for $35 a contract. So if you're doing, we'll use 10 contracts in all of our examples. So you would collect $350 in credit in your account for putting this trade on. Okay, that's your max profit potential. As long as Delta stays above 52 by that August week one expiration, you keep all of that money in your account. Okay, what you don't want to have happen is for Delta to sell off and breach your 52 strike put. Well, that's exactly what happened, right? So we didn't do anything wrong. We ran all of the analysis, everything looked fine, but we can't control the market, right? It's gonna throw us a curveball from time to time. It did in this case, and so when expiration rolled around, we closed out those 52 strike puts for a 75-cent debit, right? So we collected 35, debited 75. So we're net negative 40 cents. Okay. And we just went out 1 week to August week 2, so the next expiration cycle, same strike price, and we collected 148 a contract. Now, how in the world could we be debited 75 a contract and then all of a sudden be credited about twice that amount? Well, that's the beauty of rolling. So when a stock sells off, because of that inverse correlation with implied volatility, right? Stock goes down, implied volatility goes up. Okay, so the option premiums get juicier. And we're going out in expiration. So we're adding time value to the trade. So most of the time you can go roll these out, go out in expiration, and do it for a net credit. That's key. Okay, you want to do this for a net credit. So we fast forward to expiration day, the August week 2 expiration cycle, August 8th. Okay. At that point in time, stock was, when we closed this, the stock was sitting at 52.75. It was only 75 cents above our short strike. Okay. But we can close this for a $0 debit, which is what we did. And the net profit potential on a 10 lot was $1,080 because of that rolling adjustment. So I'll back up just a second and point something out. When this trade was put on July 18th for $35 a contract or $350 on 10 contracts, that's our max profit potential. So had everything gone as planned and Delta just stayed above our 52 strike, we would have made $350 on 10 contracts. Something went wrong. We adjusted accordingly and we came out better off than had nothing gone wrong to begin with. Right? To the magnitude of like 3 times. We like 3x our profit potential using an adjustment. So this can work because it allows you to stay net cash positive while taking advantages of decreases in implied volatility and increases in the underlying share price. Let's look at another example that we did a while back. This was a number of years back, but I think it's a good example that will demonstrate something else here that's important. So in this prior year, September 12th, we issued an alert to sell put premium on Micron with an August week 4 expiration at the 44.50 strike. That trade could be put on at the time for $55 a contract. Okay, so that's our max profit potential, right? If Micron stays above 44.50. So we collect $550 on 10 contracts, but Micron sold off and breached our 44.50 strike puts. So on September 27th, we rolled these contracts out, and I need to fix that typo. That should be August, sorry. I mean October, not August. Sorry about that. I thought I had fixed that, but it should say October. Okay, so we rolled these contracts out for a $1.19 debit. So we close out the original ones, and we go out to the October week 2 cycle. Same strike price. Collect $2.16 a contract. Okay. Expiration rolls around October 11th. Trades closed at a 52-cent debit. Now, at that point in time, the stock was trading at 43.59. So look at the strike price, 44.50. Right? The stock was trading almost $1 below the short strike. But because the sell-off stabilized, even though the stock didn't go back up significantly and was still trading below the short put strike, implied volatility came down, which benefits you as the option seller. That's what you want to have happen, right? When you're short put premium, you want implied volatility to decrease. So that's all that happened. The stock didn't recover back above the 44.50 strike. And that trade could be closed for $820 net profit on 10 contracts. That's factoring in the loss, right, on the original position, which had a profit potential of $550 had nothing gone wrong to begin with. So we came out better off, right? We just had to extend the time horizon and do it under the right circumstances in the right way. Okay, so those are a couple rolling examples, but the silver lining there in that Micron example is that you don't necessarily have to recover back above your short strike to be profitable. Okay, a lot of times we can do these in just 1 or 2 adjustments. Sometimes we have to adjust them more. I mean, we've had some that we've had to adjust for extended periods of time, but each subsequent adjustment that you're doing should be bringing in a net credit. So the more adjustments you have to make, theoretically, should allow you to come out even better off, as long as you're doing it correctly. That's pretty cool. Now, I mentioned I'd come back to my account from back on August 24th, 2015, the day of the flash crash, where I had this portfolio of short put positions. Every one of the underlines here is down. Every stock ETF and index that I sold puts on is down, in some cases, double-digit percentages. And I have a net P&L on the day of over $7,600. I should have a loss. Okay, I live in the Mountain Time Zone, so this was taken 6 minutes after the cash open at 7:36 a.m. How did I do this? This was done using delta neutral hedging. So I delta neutral hedged my short puts when the underlying breached my short strike. And I'm going to give you the formula for that. Most of this you don't have to calculate because your broker platform will calculate it for you. But more for purposes of understanding, there's just one little calculation you'll have to do. I'll show you what that is. But basically what we need is our position delta. And that's what your broker platform should give you. So that's just the number of contracts in your trade times the delta times 100. Okay, so you need to know what your position delta is. We're then going to, and this is where we're just going to do a very basic math here. We're going to divide the at the money option delta by the position delta to get the number of contracts to buy for our hedge. And that results in a delta neutral hedged position that can profit on a decline in the underlying security. So here's an example of what that looks like. Okay, it doesn't matter what the stock is, but let's say we sold 58 strike puts on this stock. Okay, well, as you can see, those contracts, that strike is now in the money, meaning the underlying stock sold off and dropped below the 58 price level, which is what we generally don't want to have happen. Okay, so if we wanted to delta neutral hedge this position, how would we do it? Well, first we need to get the delta, which is 59, and you can ignore the negative. Puts have a negative delta, right? Calls have a positive delta. We just need that number, 0.59. And we'll use 10 contracts in our example. So if we plug that into the calculation, right? If we had sold 10 put contracts at the 58 strike, our position delta would be 590. So if we want to delta neutral hedge this short put position, we would go to the at the money strike. So the strike price closest to the underlying share price, the 57 strike. We get that delta, which is 48, divided into the position delta, and it will spit out a number. Okay, in this case, that's 12.29. Well, we can't buy 12.29 option contracts, so we'll just round up or down to the nearest whole number. So we'd round down to 12, and that tells us that we would need to buy 12 57 strike puts to delta neutral hedge our original short 58 strike puts. So we're not touching those. We're leaving those alone because who knows? The stock could recover and trade back above our 58 strike. So we want to keep those open if there's evidence of the stock recovering. But as long as it's selling off, we can beat delta neutral hedge. And if that sell-off magnifies, right? If you get a significant sell-off, that hedge at the 57 strike can the profit in those contracts can outpace the loss in the short strike. But this is exactly what I did on August 24th, 2015, the day of the flash crash, where I had this portfolio of a dozen or so short put positions. I delta neutral hedged them, and we got a huge sell off, right? And I had a net profit due to that one adjustment strategy. Okay, so that's delta neutral hedging. All right. And by the way, I'll save plenty of time for questions at the end. So I know questions are coming in, but I want to make sure I get through everything. So I will stay as long as I need to answer questions. But let's move on to some other strategies. So let's talk about credit spreads and iron condors. So these are also very popular option selling strategies. Okay. So credit spreads involve buying cheaper option contracts, simultaneously writing an equal number of more expensive option contracts, defined risk, right? You receive a credit or cash into your account for executing it, just like selling put options. That's often why they're referred to as credit spreads. Okay. And then an iron condor is just the combination of two credit spreads. So credit spreads are more neutral to directional, right? So you got a bull put credit spread or a bear call credit spread. Iron Condor more market neutral, so you're simultaneously doing a bull put credit spread and a bear call credit spread on the same underlying, same expiration. So when I first started trading options back in the 90s, right, I was just buying calls or puts like most people. And then the typical transition is then you go to vertical spreads, right? So from there, I went to selling credit spreads. And at first, I loved it because I think I had like 10 winners in a row. And I'm like, wow, this is so easy. I'm quitting my day job and I'm going to do this full time. Because when I was just buying calls or puts, I had to hit a bullseye, right? I had to be right in my delta, gamma, theta, vega. I had to be right on the timing of the move and the underline. Everything had to line up. And it was very difficult to do that. And I found that when I was selling credit spreads, don't want to say that I was being sloppy, but there was a lot more margin for error, right? I didn't have to be so precise. And I was winning a lot of trades in a row. So I could kind of throw darts all over the dartboard and still potentially make money. And I liked that. But I'm glad I didn't quit my day job because it was on that 11th or 12th trade that I wiped out all of those winners from the 10 previous trades. And then reality hit me and I'm like, okay, well, this isn't such a great strategy because if something goes wrong, then I've wiped everything out. So this was sort of the initial starting point of my focus on trade management. So I'm like, there's got to be something I can do to address these situations rather than just let the trade go and take the loss and wipe out all these winners. Now, there are going to be scenarios where you're still going to have trades that wipe out a series of winners. It happens to the best of us. We can't avoid it completely, but you don't need to avoid it completely. You can have a bad trade. Allow yourself to have a bad trade from time to time. I tell myself that, right, regularly. I'm like, even though I've been trading for 26 years, I manage a hedge fund now. The knowledge I've acquired over the decades has been tremendous, right? But I still make mistakes and I still have bad trades. So allow yourself to have a bad trade from time to time. Just as long as you're using good risk management, you'll come back from it. You just got to constantly remind yourself of that. And that really requires confidence, right? And so this is where I think trade adjustments can really boost your confidence level and address these types of situations. So how do we adjust a losing credit spread or iron condor? Well, we can also delta neutral hedge these trades. It's a little more complex, not much, but just some different steps. So to transform a credit spread or iron condor into a delta neutral position, if either the short put or short call strike is breached, for instance, if we do it right when that breach happens, we can just close half the contracts at the breach strike. That's generally going to bring our delta pretty close to neutral and help offset losses and even produce a profit if the underlying continues to move past the spread. All right. So delta neutral hedging can produce winning trades with a profit potential greater than the initial credit, just like we looked at in the rolling example with selling puts. But you got to know when to do it, under what circumstances, and make sure you're doing it correctly. So let's look at some real world examples. Okay, this is one we did in a prior year on the S&P 500. So we did this one a while back. We don't use this adjustment very often. So I have to go back years to find examples. But this one was done on June 15th. Okay. S&Ps were looking kind of range bound. So an iron condor seemed appropriate. We went up to the June week 5 expiration, set one up on the SPX for $110 per contract credit. So again, if you're doing 10 contracts, you collect $1,100 into your account when you put the trade on. That's our max profit potential. In this case, the S&P sold off while we were in the trade, breached the short strike in the iron condor, so the short puts, which were at the 27.25 strike, leaving, and it happened very, very quickly, right? So quickly, and I think close to expiration. So it left the position with a potential max loss, which was $3,900 on 10 contracts, right? So if you're just trading one contract, looking at a potential loss of $390. So we can accept that and move on. But what we did because we just broke through a major support level on strong volume. So a lot of downside momentum. There was no other identifiable support below there. Market environment said, good chance S&Ps are going to continue to sell off. So we delta neutral hedge this the very next day on June 26th. Closed half of the 27-25 strike puts. The day after that, June 27th, this position was closed out for a $240 per contract profit, taking what would have been a $3,900 loss if we just accepted it and moved on to a $2,400 per 10 contract profit potential. So once again, if you go back to June 15th, had S&Ps just stayed inside our spread in between our short put and short call strike, the maximum we could have made on this trade on 10 contracts was $1,100. But something went wrong. We used the delta neutral hedge adjustment and came out with more than twice the profit potential that had nothing gone wrong to begin with. So again, delta neutral hedging really works as magic when the underlying continues to move in the direction of your breach vertical credit spread. This is the only hypothetical example I have in the session. So I'll share this one because it's another way to delta hedge your position. And this one is a credit spread example, and it's one we were actually looking at trading, but for whatever reason didn't end up issuing the alert. But even when I do all my homework, identify a trade, if I don't end up trading it, I still use it as a learning example. And so that's why I saved all this. But I'll show you what I was looking at. So this is on Apple. And this was back in December of 2020. So early on in December, Apple rotated up into this area of resistance right around 125.50. So you can see it tested that back in October, it rejected it, and it's now retesting it, and on December 9th was rejecting it again. So the idea here was to use that resistance level to structure a bear call credit spread, right? To sell a short strike call and then buy a higher strike price long call. Well, you can see what happened on the chart, right? About a week later, Apple blew right through that resistance. Right? It went from like that 125.50 level where the resistance resided up to around 139.50, 139.50. So it hit that next area of resistance. Okay, so this is what we wouldn't want to have happen if we sold a call credit spread. Okay, there's the breach of the resistance. So the idea here was to sell a 125, 127 call vertical. Okay, so we would want Apple to stay below 125 by December 21st. Obviously, as we saw on the chart, that's not what happened. It blew right through. It blew through that whole spread, right? But this trade could have been put on for a 59-cent credit, so $59 a contract or $590 credit on 10 contracts. So that's our max profit potential had everything gone according to plan. All right. Well, if we fast forward when that breach occurred and you look over to the right, the position would have faced a loss of $560. Okay, so we could take that loss, move on. Or how could we adjust this? What could we do? Another technique with credit spreads, if you get a breach like this, you can plug along either call or put, depending on whether you're doing a put credit spread or call credit spreads. This is a call credit spread, so we would plug a long call right in between our spread. So we could go out and buy a 126 strike call if we think that directional move on the breach is going to continue. As far as position sizing, my rule of thumb, so you'd be closer to delta neutral if you used half the number of contracts in your original spread. So if we bought 5 126 strike calls, that would be more conservative. The max I'll do is the equal number of contracts in the original spread, so 10 contracts. All right, so you can do somewhere in between there. Okay, it's going to be dependent on variables like, how big was the breach? Was there a lot of volume behind it? How much momentum was behind it? Was the close near the high? All those things. This was an aggressive breach. right? Big green candle, breach of a strong resistance level, close near the high, all this stuff. So we may want to use a more aggressive position sizing. So we plug in 10 contracts at the 126 strike. Same expiration. Fast forward. What happened? Well, we continued to lose money on the original call spread because Apple continued to rotate higher. So had we just not touched the position and stayed in it, right, we would have had a loss of almost $1,400. The 126 strike calls, the adjustment that we made to would make to that trade, had a profit potential of 6,300. So by delta, and this wasn't a delta neutral, but it was a delta hedge, right? We adjusted the deltas in the spread to match what the market was doing, to match how Apple was trading. So if you subtract the loss from the original credit spread, the net profit on this is just under $5,000 on a 10 lot. Okay, instead of a $1,400 loss, had we just done nothing. And so that's another example. Let's look at I think this is a rolling example. This is a real world one. We did this with our members at Altus back in 23. So October 6th, we identified an area of resistance on LABD, LABD. October 20th expiration, we alerted our members to sell a bear call credit spread at or just above resistance. That could be done for $20 a contract. So you put on a 10 lot, you're collecting $200 in your account immediately. Okay. In this case, LABD breached the 25. So we did a 25-27 call spread, 2-point wide vertical, breached that spread, leaving the position with a potential max loss. Now, it was bumping up against some other resistance, and there was evidence it was going to roll over and come back down. So in this case, we used a rolling adjustment. So we adjusted on October 20th by rolling those contracts out. And we did it for a net credit. So there was a $70 per contract debit rolled out for a $75 per contract credit. So we're adding a little bit of credit to that trade. And now we're just waiting for implied volatility and or LABD to come back down. November 3rd rolls around, the spread's closed for a $25 per contract profit, turning a potential loss into a $250 per 10 contract profit. Now, once again, go back to the day the trade was put on, October 6th, for a $20 credit, right? Max profit potential is $200. Can't make any more than that. So had LABD just stayed below the 25 strike, that's how much we would make. We just keep that entire credit. In this case, something went wrong. We made an adjustment and came out better off than had nothing gone wrong to begin with. Not a lot better off, a little bit, right? But better than had nothing gone wrong to begin with. So I want to now give you some crucial tips to adjusting trades. So you may have noticed with some of these examples that trade adjustments can be both defensive and offensive. Okay, so you want your trade adjustment to match the strength of the move in the underlying security, right? So if the market's in a sharp decline, right? Let's say you sold some put premium, market's in a sharp decline. A delta neutral hedge might be more appropriate, just like I did back on the day of the flash crash in August 2015. Okay, and that can potentially turn losing trades into big winners. If you just get a slight breach, the market's maybe calm, it's not a major breach or maybe a major support or resistance level, implied volatility is not all that elevated, then rolling might help us ride out that trend until it reverses. But the trick with adjustments is not only knowing how to execute them, but when and what to adjust. So you don't want to obviously just do it blindly. But now you know that a high percentage of losing trades can be avoidable, can be fixed, can be mitigated. And in my experience, it's as high as 75%. And there's an adjustment to fix virtually every bad trade. We can't fix all of them, but we can fix a lot of them. And remember, one trade shouldn't ever make or break you. If it is, then you're trading way too big. So if you find that one trade, even a trade that it goes catastrophically wrong, is breaking you, then you're trading too big. It's just the way it is. So size down until you could take And again, allow yourself a bad trade from time to time. And when that bad trade comes around, you shouldn't care. Then you know that you're trading the right size. But I've revealed a few of my most effective adjustment techniques to fix losing options trades. Um, when I first got into trading, right, like most people, it was for dollar signs. I had dollar signs in my eyes, was out there to make millions of dollars. I soon realized it's not that easy. And once I became consistent and successful, I realized I was actually trading for time. It's one of the few businesses out there where once you get it down and you can do it with confidence and consistency, it creates a whole lot of free time for you. You shouldn't be spending a whole lot of time on your trading. I realize some people day trade and are glued to screens, and if you like doing that, that's fine. But ideally, right, it should free up time for us. We can't get time back. Money, on the other hand, does replenish, right? So that's the main reason that I trade. And one of the big things we strive for our Altos members is to free up your time so you can do other things that you enjoy doing, but also trade with more confidence and consistency. For those of you who know me, I'm an avid fly fisherman. I like to backcountry ski. I love traveling. Me on the boat in the Venice canals, sailboat, in my old stomping grounds in the San Francisco Bay. But this is really why I do it. And again, if that's what you guys are looking for, then we're here to help. So we put together our Altos Triple Play package that includes our top option selling services, as well as our buy zone equity and ETF service. So if you want to get all these trades sent to you, okay, so you don't have to do the hours and hours of research that our team spends doing to find these opportunities and then monitor them over the life cycle of the trade in case there is an adjustment that needs to be made. Okay, we do all that for you. And across these strategies, so there's actually 4 strategies. There's put selling, credit spreads, and iron condors, and then equity and ETFs. Okay, so we threw that in there because not everybody trades options, or maybe trades a little options and a little stock, right? So just to kind of give a little diversification there. But across all those 4 strategies, you get 12 to 15 alerts on average. That should say per month. I don't know. Yeah, sorry, that's a typo. But on average, you get 1 alert per week. Typical holding period, 14 days. So most of these option selling trades are short duration. And we have a target win rate of 85% for our option selling services. We've actually far exceeded that over the course of a decade plus. But that's our target rate. We know what our win percentage needs to be to have a positive expectancy. So we know what we have to hit to be profitable. And it's below 85%. But we set it at that just to have a goal. And we've exceeded it. Oh, I thought I had updated that too. But it's now 431. Okay. So 430 out of 431 net winners in our put selling service. Again, unheard of. This is going back. So we launched it at the end of 2015, this service. Our first positions expired at the beginning of 2016. So this is our track record going back all the way to the beginning. We've never had a losing year. So we've had a net profit every single year. We've traded through bear markets, black swan events, market crashes, all that good stuff. And this is just one strategy. So there's a lot of profit potential here if you stick with this over the long run, right? This is not a get rich quick overnight thing. You're not going to be a millionaire next week, right? But you can see what's possible with just one of these strategies over the years. So I love the quote from Tony Robbins, right? If you want to be successful at something, find someone who's achieved that success, those results, and copy what they do, right? And that's what we're here to do. So we want to guide you with live trade examples to help reinforce what I've taught you on the session. And then also learn how we make adjustments to trades that aren't working out in real time with live examples. You can know this stuff. You can know the formulas. know what the adjustment strategy is, but it's like anything else. You have to put it into practice, and it's doing it in different environments where the real learning comes in. So that's where I think the real advantage lies and why we offer this. So the idea here is to use the trade alerts as reinforcement to test your proficiency and then raise your confidence, right? This is what one of our alerts looks like. This is an actual alert we sent out in the past. It's an Iron Condor. So we give you annotated charts. We map out key levels, show you everything you need to know to route this order or this trade to your broker, right? So even if you're brand new, the instructions just be copied and pasted basically. This is one we did on the TLT. Had a absolute return of just over 19% in only 2 weeks, annualized out to over 495%. So we turn these trades over rather quickly, and that's where you can really compound your returns and get those high annualized results. This is an example of one of our buy zone stock alerts. This is one we did on Morgan Stanley. Alerted our members to get in right around 52 a share. This one was closed out Jan 16, 56.05. So only 13 days in that one, annualized return of 266%. Here's an example of a credit spread alert on the triple leverage Qs. Again, these are all real alerts we've actually sent out. This one, just to kind of give you an idea of what the credits and stuff are, $54 credit, so $540 per 10 contracts. This one was almost a 22% absolute return. That's actual return on cash, right? In only 13 days, annualized out to over 616%. All right. So you get access to our best trades in real time. You don't have to sit and watch your computer all day. So we actually send all of our new alerts out after market hours. So they go out in the afternoon or evening. And I've actually got a couple lined up for you today. You have that day and the next morning before the market opens to enter the order if you want to take a trade off that recommendation. So no need to sit and watch your computer. Only exception is we will send adjustment alerts out occasionally during market hours. But it's very rare that we have to adjust positions. Again, it's probably somewhere around 10% of the time. And you get an alert, right, sent directly to you with the instructions. So it's not like you have to do it right then and there at that second. You get the easy to read instructions, annotated charts, order entry screenshots, and trade adjustments are included in our triple play package. So not only do you get all the entry instructions, if we do have to make an adjustment to any of these trades, we send you those as well. Our track record over the years has been off the charts, right? And our put selling service, right? 100% winners with adjustments. And we've only had to adjust, I think, a few of those, right? We have some losing trades here and there, but over more than a decade, we are net positive. Okay, so these strategies have built-in edge and positive expectancy. All right, so I'm going to let you know how you can take advantage of the triple play package and also let you know the other things that are included with it. It comes with even more. So it's an entire year of our top option selling services and our buy zone stock and ETF service. It includes trade adjustments. It includes our weekly live strategy sessions that we hold every Tuesday at 7 Eastern. It includes access to our invitation-only private Facebook group of around 1,000 members. It's going to come with additional training for trade adjustments. So we got about an hour together on the session. We also built an online curriculum that goes into much more depth on adjusting trades that aren't working out. That's built inside our Professional Trading Series online course. So you're going to get the adjustment component of that course, but you're also going to get the entire course, the entire 10-hour plus Professional Trading Series online course as bonus number 1. And then you're going to get my ebook, How to Create Low Risk Trades, as bonus number 2. And your first alerts are going out today. So there will be new alerts being issued this evening. You'll have access to those, and you can trade those if you choose to do so for tomorrow. and I've got two really good ones going out. So I'm excited about those. Retail value in the package is over $4,500. If you bought all this from us retail price, we are knocking 78% off the triple play package for today. So you get the entire year and four of our very best services for just $9.97. It is limited to 20 seats. If you want to scoop one of those up, altostrading.com/bundle will lock you in at that 78% discount. I'm going to take questions here in just a second. I see some questions came in. Is this right for me? Who's this for? So we designed this for everyone from beginners to seasoned traders. So if you're just starting out, again, you get all the instructions. You could literally copy and paste or read it to your broker. Or if you've been trading for a long time and you just want to free up your time, right? So it's all the above. If you work full-time, part-time, retired, we also designed this so that most of the alerts go out outside of market hours. So you don't have to be glued to your screen. We have traders, members in over 100 countries across the globe. So nice thing about trading, right? You can trade from anywhere now. This works with any account size. So you decide how many contracts you want to trade, what your position size is, right? Based on your risk tolerance, all that stuff. If you want to learn how to really do this on your own in live market conditions, this is the way to go. But if you also just want to get spoon-fed the trades, that's perfectly fine too. We have members in our triple play package that do both. Some really want to learn and do this on their own, and we're here to support you and help you do that. And others who just want to be spoon-fed, and either one's perfectly fine with us. We have members in these services from the beginning. So we literally have, I'm just blown away. Like we have traders who have been in these option selling services over 10 years. So I think that's a testament to how well they've done, right? We have a guarantee with this triple play package as well. So if you aren't profitable in the first 90 days, so your first 3 months, okay, and that's even if you don't trade this. If you just paper trade it, that's fine too. We're going to give you $1,000 to spend on any of our highly acclaimed online trading courses, coaching services, indicators, and we'll give you an additional year of trade alerts on us. Okay, so you get $1,000 store credit and you get an extra year. Because we believe in this, obviously, right? So we want to back it up and we want you to be comfortable taking the step to be a part of the triple play package. All right, so once you join, you're going to automatically be added to the members list. You're going to start receiving your trade alerts. Again, I have new trade alerts set up to go out this evening. You're going to get directed to the Trade Alert membership registration page. If you don't already have a member portal with us, we'll get you all set up and registered. You're going to receive a confirmation email confirming your access, and then you'll find all of your bonuses and anything else that was included in that package inside your members portal. Okay, so remember you get those 2 bonuses, the professional trading series. Those are our very best option stocks, equities, Forex strategies, all in one course. You can watch it online at your leisure. And then you get my latest ebook. So I'm going to go ahead and open up to questions. And since I haven't really been monitoring and I see quite a few have come through, Richard, if you don't mind relaying questions to me, I'd be happy to take any and get those answered.
Yeah, I got a handful of a mixture of technical questions and questions about the services. This one came in a little earlier. From Greg, he said if we can't do long single options, unless they have a cash account, can rolling long options work the same way as the selling options route?
Let's see. So if you can only do long options, no spreads, can rolling long options work the same way? So yeah, you can roll long options as well. It doesn't work the same way. The mechanics of actually rolling the trade would be the same, right? You debit your out of one trade into the other. but it's not going to work the same way as if you had sold an option and then you roll it out for a net credit. So it is different. But we don't offer any long call or long put option strategies. So these are all option selling strategies in the AAA package. So put selling, credit spreads, and iron condors. But yeah, for your own purposes, you can roll long options as well.
Tim asked about what size account would you kind of recommend for someone who wanted to trade the put writer? Do you have to have a pretty big account to trade that strategy or those alerts?
Yeah, so with put selling, I always recommend that you do what's called cash secured puts so that you have the cash available in your accounts to cover the cost basis of those shares. Most brokers do offer margin, right, where you can um, sell a number of contracts beyond what you'd have in your account to cover the assignment of the shares. I don't suggest doing that. Um, but it's essentially going to be, so I guess I'm trying to think of a good way to help you out with that. So most of the most of the stocks that we sell put options on are priced somewhere between 15 and generally I'd say 30 to $40. Sometimes it goes a little higher, sometimes a little lower, but they're generally in that range. And so obviously you decide how many contracts you want to trade. So, if you just did a one lot, right, one contract, it wouldn't require generally all that much of capital. So it's doable. Um, but would you be able to trade 10 contracts, right, with a $5,000 account? Then, yeah, I would say no. You'd have to have a portfolio margin account and really over leverage yourself. Um, but it's certainly doable if you're just trading one contract. Yeah.
Let's say with like the credit spread service or the put writer service, do you usually roll um, at the end of the day or at expiration?
So nearly always we roll on expiration day. And the reason for that is you want to give the trade as much time. We've had trades that breached a strike during the life cycle of the trade and ultimately recovered by expiration. So had we rolled, it would have been unnecessary. So it's best to give that as much time if you're using the rolling adjustment and wait till expiration. If if the contract's really moving the money and you're concerned about getting assigned or something like that, you can roll out prior to expiration, but we typically wait till expiration day.
Do you have to day trade to be a part of these services?
No, no day trading. So this is all pretty low maintenance. Uh, I always used to hate this set it and forget it. So you should never forget your trades. But um, again, we send the alerts out when we issue a new recommendation. They go out after market hours. So you have ample time to enter those. And virtually none of our trade recommendations or adjustments are so time critical that you have to be right there and do them right then at that point in time when it goes out. Um, and so yeah, you generally have a full day to act on. Um, at least at the very least, you have hours, right, to act on these alerts.
So rest for said, thank you, Jeff. I just joined the services.
Awesome, welcome, welcome.
He's excited to get started.
Great to have you.
Let's see. Got a rolling question. Can rolling a trade work with zero DTE type trading environments?
Sorry, could you say that one more time?
Can rolling a trade work in like the zero DTE type environments?
Oh, uh, yeah, you could do it with any expiration cycle. Yeah, so like if you sold zero DTE premium, you could, it would be no different really than selling premium 2 weeks out. You could still roll it out if you want to extend the time horizon of that trade. Yeah, with rolling the expiration cycles are at least the expiration cycle of the original trade is not necessarily relevant. It's the one you're rolling out to, and you want to make sure that you're giving the trade enough time So you want to obviously exercise some judgment there, right? If you get a big breach of you sold put premium, for instance, you get a big breach, big sell off, right? You got to take into consideration how long might it take for implied volatility to come back down or for the underlying stock to recover. And that requires some discretion. So you may not want to just roll out a week. You might want to roll out 2 weeks or 3 weeks. But otherwise, yeah, you could do it zero DTE as well.
Bridget asks, do you need any sort of special approval to trade these options?
So yeah, every option strategy has what's called a broker level of approval. And it's typically 4 levels. So level one is you can just buy a call or buy a put. Um, it does vary a little bit by broker, but um, typically then level two would be vertical spreads, right? Like so credit spreads, vertical debit spreads. Um, selling naked premium requires a higher level. And so also remember that if you don't if you don't want to sell naked puts, that's fine too. That's why we bundled everything into this triple play package. So we have members in the package that don't sell puts. They just do vertical spreads. They want the defined risk. They want the lower margin requirements, the lower level of options approval. So they just do the credit spreads, and that's fine too. But yeah, each one does require different levels. And so I would recommend checking with your broker to confirm that.
I had a good question. He said, do you ever take partial profits on these alerts or to see how they work out to the very end or adjust or
Yeah, so occasionally, again, it's dependent on a number of variables. For instance, if the underlying stock's trading close to a short strike near expiration and we haven't captured all the credit, we would issue an alert to close it out. So we do that occasionally. Most of the time, like well above 90% of the time, we let these things go and we capture that entire credit. So it's pretty rare we close it out early.
what am I going to follow up about the zero DTEs? He said, can you do a delta neutral hedge closing one side and one half with zero DTE?
Yeah, you can do it with any expiration cycle. Um, you'd want to be very careful with that zero DT. If you're selling option premium, uh, you've got a lot of gamma risk as a short option seller. So you'd be exposing yourself. So you really want to know what you're doing. And if you're over leveraged and you're short that much premium, then or long premium and it collapses and reverses on you quickly, you could have a big loss quickly. So yeah, you got to be very careful.
Does gamma exposure ever come into waiting till expiration with these? Do you worry about that?
Yeah, gamma exposure comes into play in every options trade. And so yeah, as you're getting closer to expiration, gamma is going to be at its peak for the at the money strike. So if your underlying is trading near uh, your short strike, there's going to be a lot of gamma risk in that. So we would look at taking profits, right, and not exposing it to gamma risk near expiration. That's kind of a more complex explanation of what I mentioned previously, right? If the underline's trading near a short strike near expiration, then we would close it out.
Cool. A lot of technical questions coming through. I think this is really kind of pique
Yeah, I
people's
did catch
interest.
one from Neil in the chat. Just caught the corner of my eye for the guarantee, asking what does profitable mean. So if you haven't made any profit in the trades from this service, then it's not profitable. So it's not correlated to the cost of the package. If you haven't even made $1, if you haven't even made a penny, then you're not profitable, and we'll honor the guarantee.
Awesome. Good stuff. Do they have to trade all of these alerts? Is it where every single one they must trade them or what's the flexibility there?
Yeah, no, not at all. Obviously, your discretion. You decide which trades you want to take. It is a pretty good number of trades, right? Again, on average, you get one alert per week per service. Um, so you're going to be getting about 15 to 20 alerts per month. It's going to be dependent on market conditions. So, there might be conditions where selling puts isn't a good idea. And so we may not do an alert that week. So it'll vary by market conditions, but you'll get over the long run a pretty good number of alerts per month, and often more than one person might trade. So you certainly don't have to trade all of them. Or that question came up about, a couple people I had questions like, I don't do naked short puts or don't have that option level approval with my broker. Um, then you don't have to trade that particular strategy. You have other options that you can do with like the vertical spreads. So don't feel like you have to trade every single one. That's up to your discretion, your account size, and a lot of people are trading other stuff outside of these as well. So um, don't feel like you have to force these.
And for the new traders who maybe aren't as familiar with these strategies, does the professional trading series kind of outline what you're doing in these services?
It will, yeah. So a lot of uh, what we've covered on this session, we will elaborate more on that and go into more examples. But it will cover a lot of the strategy that we talked about tonight. So it'll go also more into identifying these trade setups and adjusting them and all that stuff. So yeah.
Is there like a members area to check out any past alerts or
Yeah, yeah. We publish all of our track record. I think, do you put those in the members area, Richard, or
Craig does? Yeah, I
Greg
did
does?
it for
Yeah.
5 years. He took over. He took the torch.
Yeah, yeah. Well, and yeah, and we can get you track records too if you email us. But yeah, you have access to all that.
I think we've got probably every single trade alert with the chart, all the details, all the order information, all the adjustments on all the alerts in the members area, probably going back 7, 8 years. So everything's there. Let's see. I don't see anything else popping through, do you?
Let's see. Scroll through here. I'm not sure I understand Colleen's question. So delta neutral is means that your position doesn't have directional delta. So um, if if you sell put premium, right? Let's see, you said 30 delta. How does rolling to delta zero? So rolling is not uh, correlated to the delta. So you wouldn't roll delta zero. So those are two different things, Colleen. Looks like your question is how did rolling to delta zero come about? So yeah, they're two separate things. So when you determine your position delta in a trade, you would have to offset it with another trade. That's how you go delta neutral. Hopefully that helps. But it's not correlated to rolling. Those are two different adjustments. Let's see. There's another one that just came in. Put writers aimed at stocks versus doing an ES option. Yeah, so the put writer strategy is going to be on equities and ETFs. Um, so it'll be focused on stocks. It's not on options on futures. Correct. Oh, hey Donna. Oh, Craig, do you see Donna's trying to join, but is getting something for additional with the put writer? Did you see that one?
Looks like he's working on it.
Oh, Craig's getting it. Okay. Yeah, Donna, we'll look into that. And Craig's going to answer you. Yeah, Steve said trade adjustments seem to be more of an art than mechanical. It's kind of a, yeah, Steve, it's kind of a combo. It's kind of art and science. So we have formulas that we use and things like that, but where the art comes in is that no no scenario is identical to the next or the past. And so you have to take variables into consideration, and those variables, of course, are variables, the name implies. So, uh, yeah, there are variables that need to be taken into consideration. So each one can be a little different. But the question is, do we teach a system to adjust all types of trades in various market conditions in the materials? So we don't cover every trade. I mean, it would take a huge amount of time, right? There's so many strategies out there and so many adjustments. If you did a matrix of that, it would be in the hundreds, if not thousands. So yeah, we don't do everything, but um, the main ones we cover the what we looked at on the session tonight. All right. I think we got that one. All right. That's all I see in the Q&A. So I haven't looked at the chat, but if we missed any questions, you guys can always submit those to us at support@altostrading.com. Be happy to answer any questions that we may have not gotten to. Okay, Craig's helping Donna. Good. But just want to thank everybody for joining tonight. I hope you learned something new. I hope this was helpful. And welcome to all of our new Triple Play Package members. Again, you'll be getting your first alerts today. And then you'll have tomorrow to enter if you decide to do so. So wish everybody well and hope to see you on the next event. Again, if you have questions, let us know. Support@altostrading.com. All right, take care, everybody. See you soon.